So lots of ground there. So I guess so maybe Dirk, I'll ask you a question next. And I have to admit that this isn't a subject that you had raised as being interesting, but I have, it'll be learning experience. So maybe if you can talk a little bit about IFRS level 1, 2, and 3 assets.
Okay. I guess most of you will be familiar with the level concept in IFRS. So every 6 months, our external auditor turns up and asks us to put all the positions into level 1, 2, or 3, depending if it's completely market price, a model with market observable parameters, or if it's a model which uses any subjective parameters. And in our last year-end audit, we had interesting discussion with our auditor, which is not Deloitte. And they were asking us, so if you now calculate the CVA for your OTC derivatives, and in your CVA calculation you have historical correlations included, which are, according to IFRS 13, level 3 parameters, shouldn't your whole OTC portfolio be level 3? We said, no. Doesn't make any sense. And then the discussion sort of stopped at this point, but I'm pretty sure they will come back. So this is probably not the end of the story. And my gut feeling tells me it doesn't make any sense, because then I probably should drop the level concept completely, put everything in level 3, and don't care about the press anymore. Probably we have to talk to the regulators and then convince them that the level assignment is not really relevant and doesn't imply anything on the risk of the positions. But I mean, it's a valid question. Yeah? The calculation of the XVAs, I mean, CVA, DVA is probably still something where most of the parameters you employ are market observable, probably beside the correlation. But the more esoteric the valuation adjustments become, like KVA, like tax value adjustments, I think the more parameters enter the calculation which are subjective, which are not market observable, where you have to make huge assumptions, and so the question is not completely unjustified. But I said we haven't found any solution to that yet. It's just to postpone the question or the answer. So if anyone in the audience has some experience with that, or already talked to their accountants on the same subject, then I would be very interested in getting to know what your discussion was.
Okay, thanks.
Maybe I can jump in here. As an accounting firm, although I'm not an accountant, but I think the discussion goes around different levels, and I think it is obviously true. It is, and I think IFRS 13 has also not a very precise explanation where it needs to be, and what is a market observable and what is not, and until when you have to make it as a judgment saying correlation, for example, which is the most appropriate here, is that the factor saying, now I need to put it in level 3. There's this discussions around, and I think there's no market consensus here as well. There's it's not black or white. So there's a lot of arguments going around, even in accounting firms. In our firm, the accountants struggle with that, and there's different interpretations here and there. But in essence, from my perspective, and that's how it is interpreted, was more, what is the real influence of the CVA on the whole netting set, right? So as soon as you say the CVA effect on the whole netting set is a bigger one or is an influential one, then you probably could argue when you say correlation is an unobservable, would put it into level 3, but it's not really influential, then you can stay in level 2. So there's discussions around this where you can start discussing with the regulator, saying, with the accountant, and saying, where is this level, where is this limit that we could put in place, which I've seen, and that's probably a way of dealing with it. And I think the bigger example where it's probably clearer is the discussion around implied PDs and historical PDs, right? So there's a clear understanding right now in the industry from an accountant perspective, what is level 3. So using historical PDs means level 3. On the other hand, and this is a discussion that I think and stress dramatically, is that means why is an implied PD a better measure than a historical PD for an exposure which is not traded, is not liquid, is a typical corporate or SME, and a typical business like a loan and a swap, and suddenly I have to map it to an indices and think the indices doesn't tell me more about the credit risk of this underlying exposure. So I would stress from an economic perspective, it doesn't make sense, right? So I say, as a bank, I have every information, I know everything about this company, I probably have a better understanding than just mapping it to a CDS index. But that means, on the other hand, I have a level 3 asset. But in essence, I decrease the P&L volatility, which I usually can do. So the discussion around on this CBA paper, which came out, stresses a little bit of times of what are the proxy measures that you can use, and there is an indication, which is positively seen by me now, is like there is a tendency that people start understanding that doesn't make sense anymore. And there are ways, obviously you need to argument it, you need to benchmark it, you need to show that it works, but then you have a kind of an argument, even using internal VDs and saying, this is the better measurement than just mapping it to something which doesn't make sense. So there I see a lot of movements, even from a regulatory perspective. On the other hand, coming back to the other point, is IFRS or the accountant world, regulatory world moving together? That's a wishful thinking. That's not going to happen fast. Does the market and the accountants move together? Yes, I do believe so, because what the accountants world and IFRS says, we always look at exit price, replacement values, and what is an exit price or a fair value is what somebody would pay at the market, right? So as soon as we think CVA, DVA is probably a measure that we already agree on, and when we look at close-out valuations, that it's there. So we could say now that's the fair value. Is KVA already a fair value piece? No, I don't think so. FVA, probably in 2-3 years, we would say it's also part of the fair value, so it would be part of the exit price. So I think this is an alignment which comes together, which is a time lag from my perspective. But the regulatory world, that's a different piece. And it's not going to work that way. I mean, they deal with the CVA or with this part, they say, what is the calculation on the regulatory capital, and then let's put some prudential value in it, right? So that's now the way that they're dealing with that.
Okay, fantastic. So yeah, that's an interesting subject around the evolution and where FVA fits into this, and how it's the thought that it's going to end up in the accounting piece as well. So just before we open up for some questions, I just wanted to quickly wrap up with a question for all the panel, sort of in sequence, and that's get out your crystal ball. What's your prediction for the market in 2 years' time? Can be any aspect you think is interesting.
I think we will definitely see KVA in the pricing coming. So that's my expectation, and I think it's not really coming from the market pressure itself. I think it comes from the internal pressure. Looking on the other regulatory pressure in the banking situation, I do believe that capital will be somehow charged. The question then will be, what are the pieces? Is it a full FVA, or is it just the FBA or the FCA that you charge when you already charge DVA, because of this overlapping effect that you have in these two kind of valuation adjustments already? But there will be definitely something coming, which is also a discussion, goes back when we thought about and looked at loan business. The typical loan to a customer was like, how do we charge the capital that he actually requires, right? And I think it comes back to the discussion as well, who has the better pricing, and who is able to subsidize it better than somebody else, right? It's still, that's, I think, will be definitely a big pressure in the market.
Yeah, I agree on the FEA topic. I mean, this is something, FEA, the only actual requirement for an FEA calculation, which I currently know, and this is not even final, is as part of the prudent valuation, where if you're not taking FEA through your P&L, then you have to take it against your capital. We see the English Bank of England, which published 2 weeks ago, I think, statement on their next stress testing that they will include stress testing on FEAs. There's still this debate between Hull and White and the rest of the world on if you should charge FEA or not. I had the opportunity to listen to a debate between Brigo and Hull some 2 weeks ago, and I think this is almost settled in defining it between a good and a bad FEA. So then the only thing which you need to account for is the double counting, which Mario mentioned. And I think this is something which in the next 1 or 2 years we will see converge. So probably the inclusion of FEA in IFRS 13B or whatever that will be called. Some more regulatory pressure on implementing FEA. And as I mentioned, prudent valuation. I mean, the RTS is still not officially signed. So there's no banks currently being really audited on the subject, at least not on a hard audit because it's not final. But it will be very interesting to see once this is final, how the regulator will handle the question of model risk on CVA and FVA, topic which Mara mentioned beforehand, because that sort of squares is like a CDO squared. Yeah, it's always difficult to calculate the XVAs. If you want to calculate the model risk of your XVA, that makes it sort of even more complicated. So I think this is something which will be the focus of the next 2 or 3 years.
Okay. I think the market will become a lot smaller. I think there will be less participants in the derivative markets. Some, as the existing portfolios are still there, I think we will see a lot more banks defining their kind of restructuring portfolio, which isn't then based on a credit point of view on their counterparts or market risk, but based on the resources these derivatives or the restructuring portfolio is actually employing. So I think the market is going to become a lot smaller and on the other side a lot more standardized, so that features that are not similar to the interbank standard, interbank trading standard, will all have a different, will all have a price tag attached to them.
Would agree to that. Yeah, it's a little bit wishful thinking. Yeah, so would expect that we see more collateralization, maybe even from corporates. Yeah, maybe this is not a no-go as it is always told. Yeah, maybe we will see a shrinkage in the client base, not from 20 to 10, but maybe there are only 2 to 3 counterparts, but the deals are collateralized. Would expect to see the same on this single-sided collateral, all this stuff with very good rated companies, where not CVA is a topic, but which makes a lot of problems for banks on FVA. All these rating triggers, stuff like that, very, very difficult to monitor. Maybe when it comes to hedging, we will see a better kind of hedging when we're talking about hedging credit risk. We only can hedge market risk, market volatility, but no idiosyncratic risk. The proper hedge for that, especially most of us have CVA risk with counterparts where is no liquid traded CDS, would be any kind of securitization. Put in that specific risk into any kind of SPV, which of course is it's a big work to do. After crisis where all these securitizations are very stagnated, you need presumably kind of contingent CDS to ideally hedge your risk. And my last wish is that maybe clients, and especially corporates, which are nowadays not collateralized, will have a closer look and just not only trade where the price is the cheapest, because maybe the price is the cheapest with the baddest bank due to that DVA benefit, and that is quite counterintuitive, would say, if that's the right word in English. And maybe the clients should realize, especially corporate hedgers, they go into the market where they think that they will lose money on their original underlying. They go into the market, they hedge, so they expect positive PVs under the hedge.
which immediately means CVA risk against the client, against the bank. Yeah, and definitely you would be more happy to have risk against a good rated company, and a company which takes care of the risk and has an active risk management. That's my wish. Yeah.
And to continue the positive enthusiasm for the business, I mean, I think barring a macroeconomic shock, so Greece or something in the emerging markets blowing up, I don't think you'll see a dramatic shift over the next 2 years, but a sudden shift. I mean, but you're going to see a continuation of the trend of increased costs, and as a result, rationalization of business models, right? So I don't think banks have fully come to grips with what's going on to them. So be it the larger players restructuring their businesses, the smaller players maybe exiting. I think that'll continue. And, if I wanted to see some silver linings, I mean, hopefully that'll be in the context of a positive economic environment where the banks can afford to invest in these functions. And the reason why they should or would is because derivatives do have an economic utility, right? So even though the cost might increase, it still makes sense for people to hedge, right? So it'll be a smaller market, but hopefully it'll still be profitable, and that's my wish.
Okay. Very good. Okay, so I wanted to open up to questions. I guess I just sort of comment on the. It's very it's easy in the middle of all of the changes and all of the stuff happening to get a bit pessimistic, and some I think there's certainly in some recent seminars I think it's come up. But I mean, from what I see, there's a huge amount of diversity. There's a lot of different things going on, and I do think the rationalization, the things that are changing in banks will be for the better, and that overall that there's a lot of stuff to look forward to. So I'm optimistic myself.